Hello, everyone. It's Professor Reiko here, continuing on with our lessons on investment. So our last video that I put up was a fairly long one. We did held to maturity securities pretty much from start to finish, and walk through, recording interest, the interest revenue, recording the purchase price, the interest revenue, the amortization, and then how we handle catching things up at the end to sell it. All right, so here we're going to look at the other two classifications, available for sale and trading securities. All right, so the main difference is that we are going to report these at fair value. Okay, so how do we report those in fair value? We're going to report them by recognizing unrealized gains or losses. All right, so an unrealized gain or loss just means the value has gone is either greater than or less than the amortized cost, but we call it unrealized because we haven't sold it yet. So our realized loss will be when we actually sell it. So these are considered these are considered unrealized. All right, so it's important. So it says here in other comprehensive income, and I should make a point to say I'm talking about available for sale when I talk about other comprehensive income. All right, trading securities go to net income, and that's what it says right here. So if you think about other comprehensive income, so you should have covered comprehensive income when you talked about the financial statements in intermediate one. So other comprehensive income rolls forward and gets captured in accumulated other comprehensive income, which goes to the equity section of the balance sheet. All right, so no changes in fair value are captured in net income until they are sold. So that's going to be different from trading securities that we'll talk about in just a second. All right, so we're going to use the same example that we used prior. So we have the same bonds. If you go back and watch that video, see there's 200,000 9% bonds. So we were able to calculate the interest. All right, so remember once again the interest, which is one of the two cash flows, is the face value of the bonds times the rate, and then it was times 6/12 because it's semi-annual. And that's where we got the 9,000. And if you look down here, the cash received every time is 9,000. All right, so they pay interest semi-annually. They were 5-year bonds. So in the previous example, we calculated the present value. All right, so this number right here was the present value, the 184,925. All right, so remember, investors are willing to pay the present value, the future cash flows. Those future cash flows are the principal, 200,000, and then the semi-annually interest that we're going to receive every 6 months. All right, so we put all that into the financial calculator and came up with the 184,925. All right, now we're going to assume that the bonds are classified as available for sale. All right, so the purchase price and amortization table are going to be the same regardless of the classification of the bonds, meaning held to maturity, trading, available for sale. It does not matter. So the amortization table will be exactly the same. All right, so that's a plus for you as a student because there's not different things you have to remember. All right, so we can see here I just copied this over from the previous example. I just did the first couple of rows. A couple things to point out: amortized cost. We define that as acquisition cost, which is 184,925 plus the total amortization right here. All right, so 184,925 plus 1171 is 186,096 here, and then plus the 2406 gives me the 187,331, and so on and so on. All right, so each time I'm taking 184,925 and then adding to it whatever's in the total amortization column right here. So the good thing about the table, remember the journal entries for the interest, revenue, and the discount or premium amortization come from the table. So if I'm using the same table, regardless of classification, that also means my journal entries are going to be exactly the same. All right. So right here that says that the journal entries to record the semi-annual interest and also the the discount or premium amortization are exactly the same. All right. So our difference is we must adjust to fair value on the balance sheet date. All right. So that's available for sale and trading. So let's just focus this. We're doing this as available for sale. And then down here, we can see we're going to switch to trading securities in just a second. All right, so the way that we do that is we compare amortized cost. I'm just going to put AC for amortized cost, and we compare that to the fair market value. All right, so amortized cost always comes from my amortization table. All right, so it means it's always changing. The fair market value, if you look back up in the problem, let me just scroll back up here so you can see it. You can see right here it says at the end of the first year, it's 186 is the fair market value. All right, so we're comparing the 186. All right, so the 186 is the fair market value. And then if you look at your table on 12/31/16, we can see the amortized cost is 187,331. All right, so when I write it out like this, I just typically add another column for my unrealized gain or loss. All right, and in this example, we can see it is the fair market value is less, so that is a loss of 1331. All right, so this is the number that we want to be in the unrealized gain or loss account and the fair value adjustment account, which is the other part of the journal entry at the end of the year. This is the first year of the problem, so the beginning balance in those accounts are both 0. So we'll make a journal entry for the 1331. So on 12/31/06, we are going to debit, because remember, this was a loss. All right, losses are debits. So we're going to debit unrealized holding gain or loss. And this is important here, -OCI. Okay, that tells me where the unrealized gain or loss is going. For available for sale securities, it's going to other comprehensive income. And then down below, you'll see when we do the trading, we're going to switch that up just a little bit. All right, and then we have a credit to fair value adjustment, and that's for the 1331. All right, so this fair value adjustment account, some people will call it a companion account. All right, so this is actually what adjusts the investment. Notice we're putting the investment on our books. On our financial statements, we're going to record it at fair value. So it needs to be this 186 number here. All right, but my amortization table has it as 187,331. So I need to adjust the investment. How do I do that? I do that by using this fair value adjustment account. All right, so I'm not debiting or crediting the investment account. I'm using this companion account. So we've talked about like contra accounts. If you think about like the allowance for doubtful accounts, accumulated depreciation, those are contra accounts. They're going to reduce the value of the asset or whatever they're associated with. Fair value adjustment works the same way as what it's associated with. All right, so it's associated with an investment, which is a debit, normal debit balance. So an increase, so a debit to the fair value adjustment would mean a gain has happened or increasing the value of the asset through the fair value adjustment. Here we can see it's a credit. We know that credits decrease investments, so it's decreasing the investment down on our balance sheet from 187,331 to 186. All right. So these two will be always the ones that are used in the journal entry, the unrealized account and the fair value adjustment account. You might see this called fair value allowance or anything like that, but it all means the same. All right. If it is classified as a trading security, all right, this is the only difference. Instead of putting -OCI, you put -NI for net income, meaning we would have the unrealized holding gain or loss -net income for 1331 and the fair value adjustment for 1331. So make sure you see that this -net income is the only difference between that. All right, so trading securities and available for sale, everything is the same as held to maturity up to this point, except for these, we have to adjust them to their market value on the balance sheet date so that they're recorded at fair market value when we put out our financial statements. All right, so what we're going to do next in the next lesson is walk through when we have a portfolio, meaning more than one of these debt securities, and we'll take it multiple years because we'll see that you have to keep up what's in the fair value adjustment and unrealized holding gain or loss accounts, and it's going to influence how we do our second and third year adjustments when we're preparing our balance sheet. All right, so once again, hopefully this was helpful. If you're having trouble, make sure you go back and watch it again, or go back and watch the held to maturity one as you're watching this, so it kind of have them all together in one place. And then hopefully the example we're going to do in the next lesson will help you out a little bit as well. All right, so I hope you're enjoying them. Please share these with your friends and your classmates, and hope you subscribe and keep tuning in for more. Thanks.